tax you owe. And obviously the goal of every management team is to pay as little taxes as possible. And as I said, the government has made it very easy for these major corporations to allocate revenue outside the country. Netflix doesn't pay a lot of tax. Amazon doesn't pay a lot of tax. ExxonMobil doesn't pay a lot of tax. Why? Because they allocate revenue outside of the country and they allocate expenses inside of the country. So they overstate expenses, they understate revenue, and then they allocate revenue to countries where they have tax treaties. So even on a consolidated basis, they don't pay much taxes. And that's just sort of the unfair aspect of the tax code in America. And no one seems, I don't know why, but no one seems to care. Maybe because, corporate donors are so important, but no one seems to care. And there doesn't seem to be a lot of focus on making the tax code in America fair, right? And my stance is, all right, you let every corporation in the country deduct the interest they pay off their earnings. It's a direct deduction off their earnings. Why can't I do that? Now, I've got credit card debt, I've got an auto debt. I can at least deduct my home mortgage, but even there they put a cap on what you can do with your home mortgage, right? Which makes, really, if you think about it, makes no sense at all. So I can't deduct all the interest I pay. I can only deduct my home mortgage interest, which, if you think about it, then really does push a lot of us into borrowing against our home and paying off all the debts we've got with our home mortgage, like a second mortgage, so we can deduct the interest expense, because I can't deduct my auto loans, I can't deduct my credit card loans. So this is sort of what I said, one of the unfair elements of our taxation system. Over on the corporate side, they can deduct all kinds of stuff, right? And so, as I said, you've got really two parts of your analysis that you do both as management and as an outside analyst. The first one is that you look at the cash flow of the company. And that's because without positive cash flow, the company's got to borrow, and eventually that borrowing gets shut off, which means that the company is a high-risk enterprise, and so which means, of course, that you can't raise equity capital, but if you're an owner, you're very concerned about the value of your equity, which gets crushed if the company files for bankruptcy. So cash flow is an important thing, right? And then the next part is sort of long-term, which is the payment or the assets that the company uses to generate cash flow, right? Because the long-term assets are really used to generate the cash flow of the company. If you think about, how do I operate my company? Well, I've got a plant, that's a long-term asset. I've got machinery, that's a long-term asset. I've even got my employees. There was a time when there was a proposal to let companies depreciate their labor force over, obviously a period of time. Those are your long-term assets. And you're acquiring some of those long-term assets by utilizing debt. Right? There's some of it's utilizing cash that you generate from those assets, and the other is that you're financing those assets, which is also utilizing your cash. So cash flow is incredibly important, right? And the formula that I like for cash flow from assets is your operating cash flow minus your net capital spending, which is the what you spend to buy assets minus what you got from selling assets minus changes in net working capital. So if net working capital goes down, then your operating cash flow, then your cash flow from assets goes up because your operating cash flow has to sort of balance out with your changes in net working capital. Another way to look at it is the money you pay to creditors plus the money you pay to stockholders is your cash flow from assets. But I like this upper formula better. I think it's a little more illustrative. All right. And so here's a explanation using actual numbers, right? So, in this case, your cash flow from assets is your operating cash flow, which is right here, right? So EBIT, earnings before interest and taxes, equals your operating cash flow. They're synonyms, right? EBIT's the new cool phrase. If you studied accounting 40 years ago, it would have been operating cash flow or net gross operating profit. So EBIT is before interest and taxes, is before interest and taxes, right? So you add the depreciation and you take out the taxes, right? And so here's your operating cash flow. This is not big math, all right? And so effectively, right, you should deduct the rest of your changes, if you will, in how the company operates, including your net working capital, right? And so you come up with the cash flow from assets. It's not hard to do, right? Rather than run through this for you, when you study for the exam, or if you want to sort of increase your knowledge of this, right? Start with this slide. So it's operating cash flow minus net capital spending minus changes in net working capital, and come over here to the table, right? And you can see the numbers, right? They give you the numbers. Here's your EBIT. Here's your net capital spending, right? Which is with your depreciation, which is right here. And here's your taxes. So you can get it right off your income statement, right? I've got EBIT. I'm gonna add back in my depreciation, and I'm gonna deduct out my taxes, and I'm gonna get to operating cash flow. And then changes in capital spending, right? You can get it right here from your assets, right? So from your balance sheet, excuse me. So here, right, we've got let's see, 1,000,007. Your ending fixed assets. Let me see here. Where's there we go. Sorry, 1,709,000. Whoop. Sorry, 1,709,000 is your ending net fixed assets. Right? You deduct from that your beginning net fixed assets, which gives you your change in first assets over the period, right? And you add the depreciation back in, and that gives you your net capital spending, and then you figure out your net working capital, which is your ending net working capital. It's 1,000,004, which you pick up right here, right? And you deduct out your beginning net working capital, which you pick up right. See, where do you pick that up? 389. right here, sorry. So effectively, there's your current liability number. You deduct that from your total assets. You give you your net working capital, and you deduct out your beginning net working capital, which is your total current assets. Again, sorry. Minus your current liabilities, and so there we go. So that's how you work through the numbers. It's not that hard. Take a half an hour and you'll be an expert at this. All right? And cash flow from assets is important as management, because if this number is going in the wrong direction, which means if it's negative or if its growth is negative, you got a problem somewhere you got to fix. And that means that you've either got to sell more units, you've got to raise the price per unit sold, you got to do something to fix the business, or you've got to reduce expenses. Okay? And here's just another way. You'll notice the answer's the same. Just another way to calculate it. Right? This is money paid out to creditors minus money paid to shareholders plus money paid to shareholders gives you your cash flow from assets. Now, this is important. When you are studying for the exam, a lot of chapters have this summary table that helps you focus your studying, stops you from having to leaf through the whole chapter. Obviously, I'm going to take questions on the exam from what I consider to be the important parts of the chapter. The important parts wind up in these tables. Not every chapter's got these tables, but most of them do. So when you go to study, just remember these tables exist and utilize them in your study. All right, so I think that pretty much, these are just some examples that you can go through if you want, right? Right, that's chapter 2. Let's take a look at chapter 3. So what I'm going to do tonight, if you don't mind, is I'm going to keep going, and we'll end early versus giving you a break. I'm hopeful that all of you are home, and so getting done earlier would be preferable to taking a break, and you can look. Let's be honest. It's okay. Your camera's muted. You need or want to walk around your living room for 10 minutes. Feel free. All right. Okay. So we pretty much got financial statements under our belt. I didn't want to spend a lot of time on it, but I did want to do a little bit of review so that everyone can sort of be at the same place. Okay, someone asked an interesting question in chat. Let me get to that answer after I go through chapter 3. All right. So chapter 3, working with financial statements. Part of what you do as a financial management is you're sort of an internal analyst for your company. And obviously, the bigger the company, the bigger your staff, the more you're downloading, you're delegating that responsibility to people who work for you, right? And so you're getting given to you either electronically or you're creating for your own use, these financial statements. And what you're trying to figure out is, are we profitable? How could we be more profitable? If we're not profitable, what do I got to change? And what's going on in the world around us? What's going on in our industry? What's going on in the economy in general, right? And so every management team sort of develops their own metric for information. And that's effectively what Chapter 3 is about, is how to use the information you're getting off your financial statements. And there's good parts to it and there's bad parts to it. Right? So one of the things that a lot of management teams do to help them manage their enterprise is they common size their balance sheet. And essentially what they do is they restate important metrics on the balance sheet or on the income statement as a percentage of assets or as a percentage of sales. And by doing that, you can get a pretty good picture of how your company is operating versus the competition or versus the economy at large. And what it does, it sort of allows you to compare yourself to General Electric, which is obviously a much bigger company with a much bigger balance sheet. And if you wanted to take a look at how your company, well, that's for argument's sake, which makes solar panels, is doing compared to GE's solar panel business, one way to do that would be to common size your balance sheet and your income statement. Restate everything as a percentage of assets on the balance sheet and restate everything as a percentage of revenue or sales on the income statement. And this really allows you as a management team to look at your same industry, to look at companies of the same size, companies of smaller size, companies of bigger size, and companies in other industries. And this becomes very useful when you get into the acquisition mode. So you have enough net working capital and enough profitability that you're starting to look at acquisitions to grow your business, right? And then you start to make, step one is the horizontal or vertical acquisition. So horizontal acquisitions being those companies that directly affect your manufacturing process or delivery process if you're delivering a service. Or horizontal acquisitions are essentially acquisitions in different industries. And a well thought out, well planned horizontal acquisition creates, which by the way is what created all the conglomerates in America, are supposed to be companies where their revenue and their profitability has no correlation to your business, your existing business. So in effect, if your business suffers a major problem, it's not going to affect the horizontal acquisition that you did, just as if that horizontal acquisition has a major problem, it's not going to affect the revenue of your current business, right? And management teams are always looking at this stuff, right? So not to again walk you through the balance sheet of this fictitious company. This is what common sizing the balance sheet looks like, right? So effectively everything is a percentage of total assets. So total assets is 100%, right? And then everything above and below it is less than 100%, and that's because liabilities plus equity equals assets, right? That's the balance sheet formula. So in effect, when you common size, you sum everything up to 100% on the asset side, and then you sum everything up to 100% on the liability side. And this is all a percentage of the assets of the company, and in effect, total assets should equal total liabilities and owner's equity, right? So this allows you now, as I said, to look at companies that are in the same industry, look at companies that are in even different industries, and it can help guide your whole acquisition phase if your company goes there by looking at and whether you're going to make a vertical acquisition or horizontal acquisition. So, for instance, this company, you'll notice, has a huge amount of their asset base sitting in plant and equipment. So, in effect, if they could acquire a company that, for argument's sake, could manufacture their product, they could sell off a lot of their plant and equipment, reduce this number dramatically, if not to zero, give the new acquisition a whole bunch of business, and make that business much more profitable than it was before they acquired it, right? Because it's expensive to maintain all this equipment and operate the plants, right? Not to mention all the labor. And this, by the way, this, by the way, is what causes the decision to offshore and outsource, right? So if we decided we didn't want to make an acquisition, but we wanted to increase profitability, one way to do that would be to sell off our plants and move that production offshore to a cheaper labor market, right? All we've got to do is we've got to find the entity that can manufacture our products. So once we find them, and once we negotiate a per unit cost, right, then we've just got to figure out what's transportation costs. Then we've got to figure out what are the risks in the supply chain. And if all that comes up positive, hey, this is awesome. We can sell off 80% of our asset base. Once we sell off 80% of our asset base, we've got another decision we can make, which is we can pay down our long-term debt. So if we pay down our long-term debt, and we deleverage our balance sheet, and we sell off those assets, we can operate much more profitably, provided that the cost per unit delivered doesn't increase. And honestly, even if it does increase, it still might be worthwhile to get rid of the plants, get rid of all the employees, get rid of all the debt. That really cleans up our operation. This is the decision that a lot of management teams make when they come down to outsourcing and offshoring. So that, and obviously they use this tool to make that decision, right? So here's on the income side, here's sort of the same process, right? So everything's going to be a percentage of sales. So here, instead of starting sort of at the bottom, we start at the top. And if sales are 100%, we look at our cost of goods sold as a percentage of sales. And let's just actually stop there, right? So if we do that and we look at our competition, and we find out that our competition, their cost of goods sold is only 45%. What does that tell us? Right? That tells us we've got hidden profitability in the enterprise that we've got to figure out, how did they get their cost of goods sold so low? Maybe that they're a much bigger enterprise and they're buying a lot more inventory than we are, and so they're getting deals from the suppliers of the inventory. It may be that they're buying the inventory outside of the country, right? They're going over to China and they're buying the inventory at a much cheaper price than we are, right? By looking at this and comparing this to our competition, it gives us a very good picture as to how we're operating versus the competition. And then the next sort of metric we look at is taxable income. So our taxable income is 23.8% of sales. So we now know that, for every dollar we can increase sales, we can increase taxable income by almost $24. So if we could borrow $1 million, and that $1 million would increase sales by $500,000, then we would increase taxable income by 24% of $500,000 or $120,000. If we could borrow the money at 5%, we've got a great operating arbitrage in here. We borrow money at 5%. It cost us, let's just say, it cost us, including amortization, $100,000 a year. But our interest cost, it's only $50,000 a year, right? And we can drive taxable income up by $500,000. Drive sales up by $500,000. That drives taxable income up by $120,000. So that $120,000 covers $50,000 of interest, and we've got $70,000 left, and we can use, for argument's sake, $50,000 of the $70,000 to reduce the debt, which will further reduce our interest expense next year, right? So we've got this positive operating arbitrage, which becomes clear by common sizing our income statement. This goes on a lot in the operations department of major corporations. GM, GE, they're looking at this stuff every day. And if they can, if they can create a positive arbitrage by moving something around, they'll do that. Right? That's, and they've got the opportunity because of the size and long-term profitability of the companies. Right? So,
I had a quick question about this. If you could go back to the last slide.
Sure.
I was just thinking about this from like a VC startup perspective.
Right.
If we took the same concept and I would look at my competitors and say, oh, they have a lower COGS or something and they have higher margins, right? For a startup, if I'm like a smaller startup and I'm competing with a bigger shark that maybe is more efficient, they say, okay, I compare this statements together and I see that they have these efficiencies. How as a smaller startup, now that they're going to be less focused on revenue growth and maybe margins, how could I drive those efficiencies or what have you on the margin side or whatever, so that they can survive if they compete with the bigger players, if you were advising or something?
Well, now obviously you're pushing in sort of entrepreneurship and entrepreneurial management, and that's fine.
Yeah.
My view of a startup,
right,
is that a good management team should be looking all the time at how do they reduce expenses, which means cost of goods sold. And one way to do that is to look at your more established competition, find out where they're buying the inputs you need, and going to the manufacturer of those inputs and saying, look, I looked at, I know they're way bigger than we are, but I looked at the price that our competition is paying for cost of goods sold, and we've got to reduce our cost of goods sold to their level. How do we do that?
Yeah.
Right?
And more of an analysis, I see.
Look, they may say you got to buy more all at once. The way they, well, okay, that means you have to have a storage facility. You've got to have a financing capability. That's all about planning your startup. It's doable, right? Maybe you can even make a deal with them. Look, I'll buy it from you. I'll pay you for it. You hold it for me.
You hold it for me.
I'll draw it down as I need it, which is how some manufacturers work. That's all part of starting up a company. Is you've got to make yourself aware. Use the discipline to make yourself aware of how you hold your expenses down. As I said, this was the sins of the dot-com boom. Was literally, companies were very proud of the fact that their employees were getting weekly massages, bringing their dogs to work, playing foosball, and getting really cool lunches, right? No offense, that doesn't help your operating expenses,
right?
So part of good management is you common size your projected operating statement. You look at the benchmarks that you get off of your competition, presuming that you have competition, and you try and figure out how am I going to reduce certain expenses. So in this case, obviously, this is a manufacturing company. Their cost of goods sold is a major expense.
Right.
And by working on reducing that expense, you can drive profitability dramatically.
Yeah. I was actually thinking, I actually took some entrepreneurship classes back in the day a little bit, but I was actually thinking from the operator perspective, because sometimes you can look at these smaller startups that they're advising what they have in their portfolio, and you can kind of see, like, one thing I was noticing is that, sometimes it's all just a matter of the talent itself. And, a lot of the times they call it like acqui-hire or any of these types of things, they're acquiring this talent. Now they're not, but that might be an opportunity, because now they're smaller ones, like if they happen to survive, maybe they can get some of that good talent and, have more responsibility, more ownership than maybe some of these bigger players.
Well, look, I used to teach entrepreneurship. I did for many years at Fordham. And my one of my favorite parables was that you can't win a basketball game if everyone's over 7 feet tall. Right? You have to have a couple of shorter, faster people to bring the ball up. Otherwise, you're going to constantly be losing the ball at midcourt. So that's sort of the way a startup is. You need people who understand the concept. You need people who have to know how to manufacture stuff. I mean, one of the problems that Tesla had in the beginning was that Musk forgot to hire a whole bunch of people who knew how to build a car. He figured it's not that hard. It's a bunch of parts, like an erector set. Bunch of parts, bolt them together, boom, you got a car. Right? It's not that easy. So you have to have someone who understands manufacturing. You have to have someone who understands purchasing, right? What relationship do you have to have with your vendors, and how do you build that relationship? And what do you tell them when you find out that you're paying a lot more for their product than your competitors are? Can you get them? Can you have a heart-to-heart conversation and get them to reduce the cost of your inputs? A good startup team has all sorts of expertise on it, not just one. Right? So if you're starting up a computer software company, not everyone can be a programmer. Someone's got to understand finance. Right?
Yeah, that's interesting too. Yeah, sorry, go on.
Right. I mean, someone's got to understand marketing.
Yeah.
Right? You can't all be programmers and you walk into Best Buy and go, hey, we'd like you to carry our software or some staples. Right? Someone's got to be able to speak their language.
I think this applies to crypto too, if you think about it, because they're all focused on the tech side, getting the best tech engineers and whatnot, but they didn't have simple people that understood financial compliance or these types of basic things that would have allowed them to operate. That would have been the differentiator, if anything. If they were a competitor to this FTX and they happened to be more compliant, they would have survived probably, or they would have gotten more regulation, but it would have wiped all their, they had so many lenders. I think BlockFi was one of them. There's so many lenders that blew up in like a cascading thing, similar to like with Luna, if you know. Luna had similar kind of, it was like a damage in the sandbox.
Well, look, my view of this is that this is Ultimate Greed Part 2. Ultimate Greed Part 1 was the mortgage crisis.
Right.
Ultimate Greed Part 2 is crypto. So I invent a coin. I, create the blockchain.
Right.
I use up tons of power wherever I am, which makes it look cool, and I've got lots of servers. Right. Why does crypto go up and down in value? You can't eat it, you can't wear it, and you can't build a home with it.
Right. It's no intrinsic value.
Right? Why does crypto go up and down in value? I'll tell you why. Because I make it. I run the central server. I make it go up in value. So when I see a lot of people starting to, query about buying it, I make it go up in value, and that causes a response on their part to buy it. And once they start to buy it, now I've got enough buyers, I can go borrow money, and I can use that money to buy their crypto when they want to sell it, so the crypto doesn't crash in price.
Right. Yeah.
Right? And now I get more people to buy because, like, hey, look, it ran up and it didn't go down, and I get more customers in there, and that works until it doesn't work.
Yeah, I guess your opinion on Elon Musk would be the same regarding him buying the Bitcoin with his own. I think he bought it with his own company's balance sheet or something.
Yep.
Like 10%. I can't remember, but then he tweets about it, like
Right. Let me tell you, the best thing. Had I done this, I'd be teaching you guys from jail somewhere. All right. but the best thing he did, the most interesting thing to me, was he went out and bought a bunch of Bitcoin for himself.
Right.
I think for himself and for the company. All right. So he buys a bunch of Bitcoin. He then announces that Tesla is going to take Bitcoin in exchange for cars.
Right. I remember that. Yeah.
Right. So a lot of people go, wow, this is really cool, and Bitcoin's going to finally have a commercial use, and it's going to be like real currency. So Bitcoin goes up. Guess what he did? He sold.
He sold, right?
Yeah.
Did he make money on it or no?
He made plenty of money, and I don't think that Tesla ever sold one car in exchange for Bitcoin.
No way. Really? Is that true?
I could never see evidence of any exchange between a Bitcoin account and Tesla taking place.
Wow. And then that would be like false. Well, I don't know. It's more than false advertising, I guess. I don't know what you'd classify it as.
It's fraud and greed. That's all. Pure and simple. It's fraud and greed. And listen, that's okay. Our whole financial system is built in part on fraud and greed. So,
you should try to do better, Like, we always look at the past and say that that's going to continue, but, you want to look better, see what could improve, learn the mistake.
But
not easy.
I'm sorry to be so cynical, but my view of the future is it will only get worse. Right? And that's because Sam Bankman-Fried is going to come out of this part of our financial history. Mm-hmm. Again, in my opinion, we'll see what happens, without serving jail time.
Right.
And with at least $100 million in the bank. And probably more.
100 million? That's it?
Well, I'm giving you the absolute low amount. It's probably
we were that guy. He kept like $1 billion or $2 billion or something, right? I'm pretty sure. And that's not completely.
I mean, he told the court he couldn't afford a lawyer because he had no money. Right? So there's billions floating around, and I don't think they'll ever find it. So once that happens, it's kind of like George Santos.
Are you talking about the fraud, because he put something on his college? He said that he went somewhere or something. I can't remember.
Well, I mean, think about this for a second, okay? You get the degree here at good old Rutgers, and you go interview for a job at another employer.
Right.
And this job's got a huge salary attached to it. Well, where'd you go to business? You have an MBA? Oh yeah, I've got an MBA. Where'd you go to business school? Oh, I went to Harvard Business School. Really? Oh, wow. How'd you do? Oh, I graduated in the top 5% of my class. Really? What? What's your name? Oh, George Santos. I mean, that's the problem. If this guy gets away with all this stuff, it sets a new standard. So we've got kind of two immoral heroes right now, both vying for the Academy Award for this part of our financial history, George Santos and Sam Bankman-Fried.
They're gonna do something about it though. I'm pretty sure they're not gonna stand for that shit.
About who? Which one?
Santos, you know, like he's already got it on the news, right? They're gonna like crucify him or whatever.
Well, I don't know. Does he still have a seat in Congress?
I think so, yeah.
Yeah, no, I guarantee you he does. He's still a member of the United States Congress. He's still a duly elected member of the Congress.
Right.
Now, I mean, I'm not enough of an expert, but I know that if I lied like that to Rutgers, you'd have a different teacher.
Right.
Right? They would have fired me the minute they found out I lied. I didn't go to Harvard Business School. I went to NYU, and I didn't graduate in the top 5 in my class. They canned me.
Yeah.
Right?
Those types of people, they have some internal issue where they have to do like that.
Oh, you listen.
At least earn it, and then you don't have to do all that shit.
There's no doubt about it. But bringing it back to the reality of this course, what this means is that there is some wiggle room in this whole accounting field, and these numbers are important and useful, but they're not completely accurate. And that's sort of the message, right? And so we can create ratios to help us analyze what we're doing, because ratios are important both internally and externally. But the reality is that these numbers aren't completely accurate because there's some wiggle room. And here's your study guide again. All right. So these 2 chapters, which are important, are and look. Someone asked me a question about buying the textbook. That's one of the hard questions to be asked as a faculty member, right? The reality is that I pride myself in the quality of the slides, the quality of the lectures, and I will tell you that the exam comes from the textbook, but from the slides, but the slides come from the textbook. So, do you have to really read the textbook? You should, but you don't have to. If you can, and if you have access to the textbook online where it's really cheap, if there's something you don't understand in the slides, you can Google it and you can get an answer from one of the online resources, or you can go look at the book online and go right to the chapter where the slides come from and drill down into the thing you need explanation about. And especially, this subject, finance, and we're going to go from accounting to finance to the public markets, stocks and bonds to bankruptcy. Everything is available online. So between the study, between these tables in the slides and the lectures, you should be okay. Right? Especially a lot of you have had at least some accounting. So this should all resonate. As I said, this table and the one in chapter 2 is pretty much everything you need to know. All right. So getting back to ratios, remember that working capital is your important metric, and working capital is effectively your current ratio. We play around with it a little bit, right? So effectively, the current ratio, as a management team, you always want your current ratio something above 1.2, and that's just because the lending industry, the corporate lenders at Citibank and Bank of America have decided that with a 1.2 current ratio, you've got enough excess cash flow that you can pretty much service their loan. So effectively, they look very carefully at your current ratio, and as I said, if it's not above 1.2, you got some explaining to do. Your quick ratio, where you deduct your inventory out of your current ratio, is useful, but it's easy to explain as a management team. Look, we bought some excess inventory, sales are healthy, we're gonna use the inventory over time. So the quick ratio doesn't really apply. Where it becomes important is in an environment where sales are dropping. So if sales are dropping and you've got this pile of inventory and you need sales to liquidate that inventory, then the quick ratio becomes important. So effectively, it's almost more important if the company is in distress than if the company is operating properly. Then your cash ratio is sort of the same thing. No company should keep so much cash on their books that they can pay off their current liabilities. Now, we do have sort of a new form of cash-rich company like Microsoft or Apple, where their cash ratio is greater than 1. Right? They've got a pile of cash. But the normal operating company, your cash ratio is going to be between 0.1 and 0.4, maybe, right? If it gets up to 0.5, you're probably keeping too much cash on the books, and you should consider either an acquisition or paying down your liabilities, trying to get a discount, or buying more operating assets, or maybe doing an acquisition with the cash of a company that will, help add to the profitability of the enterprise. Total debt ratio, again, is a ratio that your lender's going to look at. And obviously what they're looking for, total assets minus total equity, is effectively there is your debt. They're looking for companies that have a relatively low debt to equity ratio. And so the debt equity ratio is really much more used than the total debt ratio. And debt equity ratio is easy, right? It's your total debt divided by your total equity. Clearly, if the company is growing and if working capital, which works its way back through the balance sheet into equity, if working capital is healthy and if your debt's not growing and the company's profitable, so your equity is growing, then your debt equity ratio is going to continue to shrink because your debt's not growing, but the equity's growing. So the denominator's growing, but the numerator's not growing. And that's what you want to see as a management team. If that number starts to get towards 1, you've got some explaining to do, right? And there are companies that operate where the debt equity ratio is greater than 1. And those companies are called upside down, right? So in effect, you've got less than $1 of equity supporting more than $1 of debt. Companies can operate like that. You just have to have an explanation as to why. The healthier companies have more equity than they do debt, right? And then your equity multiplier is just a matter of how are you using the equity of the company. It's sort of a metric that is used by analysts to figure out, is the management team doing a good job or aren't they, right? So in effect, you're dividing your equity into your total assets, and that's giving you, or giving both management team and outside analysts a peek into how the company is operating, right? So clearly, if I have $1 billion worth of equity and I've only got, $200,000 worth of assets, then something's wrong unless I'm highly profitable, right? So of these 3 ratios, the most important is the debt equity ratio, right? Just as of these ratios, the most important is times interest earned. So if you go into a bank, they're going to look at your debt equity ratio, they're going to look at your times interest earned ratio, and they're going to look at your projected times interest earned ratio because they want to get paid, right? This number, the times interest earned, is all over the place. And really profitable, highly liquid companies like a Microsoft, like an Apple, their times interest earned ratio, because they don't have a lot of debt, can literally be 25 to 50 times or higher. In a manufacturing company like General Motors, they shoot for about a 10 times interest earned ratio. And if there's, a down quarter, because interest rates are higher, unemployment rises, or something of that sort, or we get a really bad winter weather quarter in the first quarter of the year when sales aren't all that healthy anyway, that number can shrink down towards 5. But they don't feel really good. I mean, there are companies that operate at 1.25 to 2 times interest earned. But you've got to have a story. And it's generally a startup story. We just started the company, we were able to borrow a bunch of money, we're building up sales are growing. So as sales grow, times interest earned will grow as well, right? Cash coverage is important, but it's just not used all that much by management or by outside stakeholders like your lenders, right? Inventory turnover and days sales in inventory are very important, especially if you have a high value item you're manufacturing. So if you're General Motors, clearly what you want to make sure is that you're turning over your inventory as many times per year as possible. And a goal, if you will, would be to have that number be 12. So in effect, if your inventory turnover ratio, which is your cost of goods sold divided by your inventory, if that number's 12, what that means is that you're utilizing that inventory a lot during the year. If it's 1, that means you're not utilizing your inventory fast enough. The problem is that your inventory costs you money. The people providing your company with that inventory, they want to be paid. And so you've got to pay for that inventory whether you're selling it or not. And that's where you get a sense of how fast are we turning the inventory. Well, we look at the inventory turnover ratio, right? Because the cost of goods sold is going to reflect how much you're selling of your product, right? The other part, and this last ratio, is what drove General Motors into bankruptcy in 2009, is their days sales in inventory got up to almost 365. So in effect, you divide your inventory turnover ratio into 365, and if your inventory turnover ratio is 1, then your days sales in inventory is 365. You've got so much money tied up in your inventory that you've got to finance it. And if you can't get the financing, you've got to file for bankruptcy. So if you look at the General Motors bankruptcy in June of 2009, they filed for bankruptcy. I think they had $8 billion in cash on the balance sheet. So you look at that and you go, why would they do that? They had $8 billion. And the answer is that their days sales and inventory had gotten to a very painful number. And so in effect, they weren't selling their product fast enough to liquidate their inventory, and they couldn't get any more financing. So once they burnt through the cash, they were out of business. And that's why they filed for bankruptcy. Right. Now, one of the places that you can finance your company is in your payables, right? So receivables and sales is how you produce cash flow. Payables is where you use your cash flow. So in the most wonderful of circumstances, right? You're selling your product like crazy, and you're taking the cash and you're holding on to it, and you're not paying your payables, and no one seems to care that they're not getting paid. So you're still getting delivery of inventory, and they haven't turned your lights off and all that stuff. But of course, that's fantasy. And so on the payable side, you got to pay your insurance policies for your employees. You got to pay your accrued salaries for your employees. You got to pay for your raw goods inventory. You've got to pay your taxes, right? You've got to pay your rent on whatever facilities you own, or you've got to pay your real estate taxes on, whatever facilities you lease, and on what facilities you own, you've got to pay your real estate taxes. And you've got to pay for your upkeep. And if you don't pay for all that, eventually your organization crashes. But on the other hand, the more you can delay those payables, the more you get free financing. And that's sort of one of the balances of financial management. And you see this a lot in the soft goods industry, where you've got a lot of smaller companies selling their product to these really big retailers. When the retailers, like when Sears, back when there was a Sears Roebuck, when Sears started having cash flow problems, they financed themselves by not paying their bills. And when their manufacturers who were selling them, bathrobes, sweatshirts, suits, shoes, said, I'm just not going to make any more deliveries, Sears said, okay, we used to buy a lot of stuff from you. We'll go buy it from an overseas vendor or some other company here in the States. You don't want to do business with us. So these smaller companies didn't have a lot of leverage against this really big retailer, Sears. So in effect, what they would do is they would slow down paying their payables. And so their payables turnover ratio would go way up. So even though they were selling, they were selling product, they weren't paying their accounts payable. So the accounts payable kept growing and growing and growing. And I'm sorry, not way up, they went way down, excuse me. And so the accounts payable would continue to grow, and it would grow faster than the cost of goods sold would grow, because they were selling the product, getting paid for the product, but they were holding on to the cash from that sale, and they weren't reusing that cash, if you will, to pay their payables. Companies are always aware of these two ratios, because as your payables turnover ratio goes down, and as your days cost and payables goes up, you're basically getting financing for free. And that for an operating company is the best of all circumstances. One of the other ratios you look at as a management ratio is your total asset turnover ratio, right? You can look at your capital intensity ratio, but that sort of assumes that you're not utilizing a lot of outside financing like loans to help finance your company. But your total asset turnover ratio, which is sales divided by total assets, sort of tells you how much of your asset base you're really using, and how much of your asset base do you need, right? And so if your assets are growing really fast and your sales aren't growing, then your total asset turnover ratio is going to go down. And if your sales are growing faster than your assets are growing, which means that you've got a healthy product sales environment going on, then that number is going to go down. Every company that makes something, that sells something, looks at that ratio. And you can, it's interesting, because this is an important ratio almost no matter what business you're in. So I don't know if you noticed, but Netflix dramatically increased the price of their service. So you look at that and you go, what drove them to do that other than, of course, greed? And the answer is that their total asset turnover ratio wasn't very good. They had this pile of assets, but they weren't experiencing sales growth. So one way to experience sales growth is to sell more units. Another way to experience sales growth is to just raise the price per unit if you can. And if you look at Netflix, you go, they don't have a lot of competition. So they dramatically increase the price of their service. They're getting some pushback, and we'll see where it winds up. But this was sort of the ratio that they were looking at that drove them to that decision, right? And the last sort of set of ratios is your profit margin.
Profitability.
And effectively, it's relatively simple. How much profit are you generating in your company through your sales? Because that's where it starts, right? The whole cash flow profitability cycle starts with sales, starts with getting your product or your service out the door, delivering it, and getting paid for it. That's step one, right? Step two is, what are you charging? Right? And what are the other expenses that you have to sort of bake in to the process in order to get a sense of how much net profit you've really got in your sales? Because you could be fooling yourself. The company could look profitable, but it's not. Everyone, your vendors, your shareholders, your lenders, and management looks at profit margin. And as part of the management process, you're constantly looking at how do you increase the profit margin? How effectively do you increase the profit per dollar of sales? And that is a very important part of the management process in every company. Return on assets and return on equity are good metrics for profitability, but the point of fact is that you could have a pile of assets and you could have positive net income, so you could have decent return on assets. Where it becomes sort of important is when you make the decision to borrow in order to increase your profitability, right? So we're going to go out, we're going to acquire a bunch of loans, and the loans are going to cost us 10%. And so we're going to use those loans to acquire more assets. Well, hold on. If we're only going to earn 10% on those assets, because that's our ROA, then we can't afford to pay 10% for the loan. Because in effect, it's zero growth. Now, there may be other benefits that we pick up, like, higher volumes and, maybe better employees and better relationships with our vendor. So those are softer decisions we make. But the hard decisions of, I'm going to borrow some money and I'm going to use it to increase total assets. What's the cost of my borrowed capital? It's 10%. Well, guess what? That's not going to work, right? And where it becomes very important on an operating basis is, what's your weighted average cost of capital? What's your WACC? Which, of course, is the blend of the cost of your equity capital and your debt capital. What's my weighted average cost of capital after tax? And if my weighted average cost of capital, tax adjusted, is greater than 10%, and if my return on assets is only 10%, and my return on equity is 14%, then I'm not very profitable here. I've got to make some adjustments. And that's why you look at your ROE and your ROA, right? That's what they tell you. How profitable are you given the money you've got to operate the company? And if those numbers aren't significantly above your weighted average cost of capital, then you're probably not operating the company profitably. And eventually, that's going to catch up with you as a management team. That's why you look at that stuff, right? When a company's public, a lot of this stuff is easier to follow and easier to analyze. All right. So when a company's public, they publish their profitability. The analyst network, right, publishes the earnings per share, the EPS, which is a very easy number. All right. It's total earnings of the company, right, divided by the number of shares outstanding times, the market price of the shares. So effectively, you report your earnings, you divide by the number of shares outstanding, and that gives you your earnings per share. So this company, had 363 million in total earnings. They had 33 million shares outstanding. So their earnings per share is 11. Now we know the market price is 88. So you divide the earnings per share into the market price, and that tells us what the PE, the price earnings ratio, is. And why that's important is the price earnings ratio tells you the leverage in the market valuation of the company. So higher earnings, higher PE ratios presumes a higher growth factor. And if the growth factor is not realized in earnings, then the stock can collapse in its market price. So stocks with low PE ratios tend to be relatively stable, like a utility, right? So utility stocks tend to have very low PE ratios and pay a pretty good dividend. And the combination of the dividend payment and the low PE ratio makes utility stocks fairly stable in their market price. You don't buy utility stock looking for big capital gains because you're probably not going to get them. Right? But if a company's PE ratio is 50 or 100 or infinite because they don't have any E, right? When we have a lot of companies that are public that have traded at very high values where they didn't have any earnings. A good example is Tesla, right? So Tesla had no earnings for a long time, but had a very high market value. So their PE ratio was essentially infinite. That's a highly leveraged stock. And when Tesla fell, it fell really hard. It was off, 60% in a month, 2 months? So the higher the PE ratio, the more leveraged the stock is, the more volatile the stock is. And so if you're an investor, it depends on how much risk you want. If you don't want a lot of risk, then you don't buy a high PE ratio stock. If you're willing to take the risk, then you buy the high PE ratio stock looking for that volatility to reward you with capital gains. Right? And by the way, high PE ratio stocks generally don't pay dividends. So your dividend payers are generally low PE ratio stocks. Right? When a company is private, or if a company has no E, they have no earnings, we developed a new metric. And that metric is price to sales. So, if you're a venture investor and you're buying startup companies, you're buying your way into a lot of these startup companies, right? How do you have a metric by which you judge your decisions? There is no E. Companies just started, and they probably have pretty good expenses, but you're basing your decision on the quality of the idea and the quality of the management team and the execution of the management team so far. Now what? Now you're going to value the enterprise. You have to value the enterprise to invest in it, right? If you're going to put $1 million into my company, what are you going to get for that? Are you going to get 5% of the company, valuing it at 20 million post-investment? You're going to get 1% of the company, valuing it at 100 million post-investment? How do you do that? If you don't have earnings, the metric we use is price to sales. Someone have a question? Okay. So you use the price to sales metric, and that's used. Now you've got a private company, right? And as I said, so you're investing in a startup. This is how you do it. If you're investing in a publicly held company that made it into the public markets but doesn't really have much in the way of much in the way of sales, so they don't have earnings. They're not even at positive cash flow. What metric do you use? You use price to sales. And that's how you can compare one company to another, right? The market to book ratio is when you are looking, you use this when you are looking for hidden value on the balance sheet of a company that you are in which you are investing, right? And it's primarily with publicly held companies. So though private companies can also have a price per share. So you can create this ratio with a private company. So you look at, so in a private company basis, right, you look at the enterprise value of the company using some metric. Could be management statement, it could be the last sale of shares in the company to an investor. You create some, and it might be your own judgment. You create a valuation for this enterprise. You divide the valuation by the number of shares outstanding, right? So that's step one. Step two is you therefore come out with you come out with a price per share, right? So in this case, we're giving it's $88, and you divide that by the book value per share, which is total equity divided by shares outstanding, right? This is all, as you can see, very simple math. And obviously, the higher the market to book ratio, the more undiscovered value there is in the enterprise. The lower the market to book ratio, the more value there is undiscovered in the enterprise. So theoretically, this market price of $88 a share, if the company's got $100 of book value, then the company's got more book value than the market is pricing the shares at, right? And the next step is you got to figure out, why is the ratio below 1? If you're buying the company, right, you don't want the market to book value to be above 1 if you can buy the company that way, right? Now, book value of the company's equity is not always an accurate indicator of what the company's really worth. There's a whole bunch of hidden value inside of these companies. That's your job as an analyst, right? How much goodwill is there and is the goodwill really goodwill? I mean, does the company have substantial brand equity? Is there a lot of additional book value sitting in the company's assets, right? This is the stuff you've got to figure out. And so the market to book ratio is used a lot in the sort of the equity analyst business or the investment banker business. And obviously, if there's a lot of book value per share and you're acquiring this company, you can borrow against the book value, right? So that's the old leverage buyout business. You look for a company that's got a relatively low market to book ratio, and you borrow against the book value of the company compared to the share price you're paying. On the other hand, what would be great would be if, and that's on a public company basis. On a private company basis, you want the market to book ratio to be very high, because what you can do obviously is go to a lender, take one of the assets, get a valuation at market, and hand the lender that valuation and go, look, I made a really good deal here. I bought these book value assets really cheap because the market value is much higher. I'd like you to lend me money against the market value of the assets. And so that's the leverage buyout business. You find a company that's got a lot of undiscovered value on its balance sheet, and you go borrow against it. All right. Enterprise value is obviously very easy to calculate. I won't bother you with that. EBITDA ratio is relatively simple. The big deal is to calculate your EBITDA, which is earnings before interest and taxes, with depreciation and amortization added back in. Right? So you take your net income of the company, you add back in your non-cash items, which is depreciation and amortization, and then you divide that into the enterprise value, and that shows you sort of what ratio you're paying to take ownership in the company. Right? You're getting a sense of how much the enterprise value is a multiple of the company's earning capacity. Right? So again, I won't walk you through these tables. I skip over the DuPont identity only because no one uses it anymore. Right? So if you want to learn about it, it's in the book. It's here in the slides. There was a time back in the from the 40s to the 60s when DuPont was considered to be one of the best companies in America. They're still a good company, but they don't have the leadership that they used to have. And DuPont essentially took return on equity and created their own formula, utilizing net income as a percentage of sales, sales as a percentage of total assets, and total assets as a percentage of total equity. And they broke these elements out to calculate return on equity, which is net income divided by total equity, which is more standard, which is fairly common how you calculate ROE. So ROE is used by a lot of different parties in figuring out how the company's operating, but the DuPont identity is not used anymore, and DuPont, frankly, doesn't have the visibility and the respect it used to have. So you can feel free to go through this, but I sort of jump over it. All right, so the last part about this is my spiel on dividends. Right? So there was a time when dividends were very important, and there was very much a part of the investment process in America that as a portfolio manager, you wanted to have income to pay out to your investors, so you bought dividend-paying stocks. And they were very important, and all the major companies paid dividends, and they paid them because the philosophical idea behind the dividend is you as a shareholder really own that money anyway, because that money is part of retained earnings. So the way a dividend gets funded is that you operate the company, you declare a profit, you pay your taxes, the remainder goes into retained earnings. And from those retained earnings, you deduct whatever dividend the board of directors approves. Right? Dividends are not guaranteed. They are applied for on a periodic basis by the management team of the company, and they are approved by the board of directors. So effectively, right, as a shareholder, it is your only interim income. You only have two ways you make money as a shareholder in a company, right? One is you get paid a dividend, and the other is that the company's stock goes up in value. You get capital gains. So one of the things that you're interested in, if you want dividend income, is how much of the earnings per share is being paid to me as a shareholder, because essentially I own that profitability. We as a class of shareholders owns 100% of the retained earnings of the company, including the latest addition to those retained earnings. So I should get paid some dividends because I'm a shareholder and I'm taking the shareholder risk. What happened along the way is that owning dividend became punitive. Receiving dividends, became punitive. Number one, the company can't use that money anymore because they paid it out to the shareholders. Number two, as a shareholder, you can't time when you get paid the dividend. The company decides what's the timing. You don't. You have no say whatsoever. So if you're having a great year of work and you're getting a big bonus and your tax rate's going through the roof, because your income's jumped a lot, and all of a sudden all the stock you own decides to pay you a dividend, that dividend, you are going to pay taxes on it at your marginal income tax rate. So you have no way to shelter that income, and you have no way to control when you receive that income. So people don't like dividends anymore, and on top of that, people would rather have the company retain that money rather than pay it out. So dividends is sort of passé. There are certain industries that still pay dividends, like the utility industries, but your big growth industries and the profitable companies like Microsoft and Apple, they don't pay dividends. People want them to continue to deploy that money to make more money on the money. Right? So the dividend payout ratio, which used to be really important because it was a way you could judge whether, if net income is going to grow, and if the dividend payout ratio is 25%, then you could project that next quarter you're going to get a bigger dividend. And that's why it was important. But that doesn't matter anymore, right? And just as the retention ratio, which is how much of the earnings the company's going to retain, doesn't really matter anymore because people don't want dividends, right? So these ratios aren't used as much as they used to be by a big amount. And as I said, dividends are sort of out of favor. You can look at this, but the reality is that the dividend retention ratio that people want is 100%. They don't want companies to pay out the dividend. All right. The internal growth rate ratio, or internal growth rate, is sort of an interesting analysis because what it shows you is that if you use only retained earnings, and that's net of the dividend, so it's real retained earnings, how much could the company grow their assets? But the reality is, who cares, right? I mean, how much do I want the company to grow their assets, right? Why grow the asset base if the company doesn't need to? So in a company where the company's still growing and is dependent on external financing, this is sort of an interesting metric. How much can the company grow if they decide to stop borrowing or they cut back on their borrowing? So, divide your return on assets, by a growth factor, and divide it by 1 minus return on assets times the growth factor, and you can come up with what the internal growth rate is. But the reality is no one cares. No one uses this anymore. Not even professional analysts use it, right? Just as the sustainable growth rate is sort of the same thing. The analysts use these sometimes, but they don't use it very much. And that's in part because of the availability in America of liquidity to corporations, either on the part of equity investments or loans, and in part because management teams would rather hold on to the cash than use the cash to
pay investors through
grow
dividend.
the company. Right? They will use internally generated funds to grow the company, and it is an important category of growth in corporate America. But what's much more important is the times interest coverage and what the asset growth is and all that sort of stuff. All right. Now, this is, as I said, sort of from the bottom of the page up, and I'm almost done. So just bear with me, please, a couple more minutes. the dividend policy that shareholders want today is stop, please don't pay me. I don't want the income when I can't manage when I receive it, and I want you folks to hold on to the cash and deploy it in the business, which of course makes your operations safer. So don't pay me a dividend, please. We have created a new metric for dividends, which is the share buyback. The share buyback, which a lot of companies are doing now, has two very attractive aspects to it. One is that as a shareholder, you can decide if you want to participate. You don't have to sell your shares back to the company. So if you don't want the income right now, you can hold on to the shares. And by the way, you're rewarded for holding on to the shares because generally the price of the shares goes up because the company is reducing the number of shares outstanding. And a lot of people look to repurchase their shares after they sell them. So the share price is generally a little more stable and with an upward bias. Okay. So a lot of, share buybacks are really sort of in vogue right now. And on top of that, there's a tax preference to them, right? When you sell the shares, if you take a profit, you're only paying taxes at your long-term capital gains rate, which is generally less than your income rate. So effectively, people love share buybacks versus dividends. So dividend policy is please don't reinvest the money in the firm. And when you get enough, have a share buyback and we'll participate if we want to and if we don't want to, right? Financial leverage ratios are very important because it shows you the operating risk on the balance sheet. And effectively that comes down to your debt equity ratio. So that's your main financial leverage ratio that people look at. The asset turnover ratio is important because it shows you how efficiently management's using the asset base available to it to produce sales, right? So that's why the asset turnover ratio is important. And of course, your profit margin is important because just because you're increasing sales doesn't mean that you're increasing the profit per unit, right? And that's a big driver of profitability, which of course is a big driver of the value of the shares for the shareholders, all right? So effectively, this is why every company creates a financial statement. This is why investors all look at your financial statements. This is why your suppliers look at your financial statements. And we've gotten to a day and age where, as I presume you know, your employees look at the financial statements. And your prospective employees look at the financial statements. And it's not unusual these days when you're the hiring manager of a company to have a prospective employee go, look, before I sign on, I'd like to look at your financials, please. I'd like to see your operating statement and your balance sheet because I don't want to be here for 6 months and have you blow up on me, right? And this was driven home recently. I presume you guys have seen all of the layoffs in like the technology sector, and even the companies that were supposedly highly profitable like Google, they're laying people off. And again, we're seeing the same thing in the banking and investment banking industry, right? People are being let go that weren't expecting it. I read a heartbreaking story about a couple that worked for Google. They both were fired by email at 7:30 in the morning. So they were working remotely. They signed on and a message popped up, your email has been blocked. Please read this message from HR. And HR said, here's your deal, you've been terminated. So, I don't know if you could have told that Google was in trouble. I haven't looked at their financials, so I don't know. But if I were an employee, I'd be reading those financials every time they were published. And every time they dropped another, form, I would look at that form to try and figure out what's going on. And I'd become an expert analyst on Google because the last thing I'd want is to be fired and not know about it, all right? So effectively, as management or as an analyst, this is the stuff you're doing all the time. You're looking at the peer group. You're using ratios to try and analyze how the company's operating versus both its peer group and, externally how it's operating versus other industries. You're always looking at the performance of the enterprise, right? And as this says, part of the problem we have now is that companies have gotten very, very complex. And so it's really hard to figure out how the company's operating. And it can be made even harder by some of these differences, meaning that, if a company's global, they might be using different accounting procedures in some of their global divisions, and some of their global divisions may have a different fiscal year than the parent company, right? So there's all these problems that you just got to work through, and there's nothing you can do about it. All right, I think that's it. All right, folks. So I'll let you go early. If you have any questions, want to ask them now, fine. If not, if you think about something, please give me, send me an email. I'm around all weekend, and we'll crank it up next week. All right. Any questions before I go? All right.
I have a quick question before after anyone wanted to ask. If you have time.
Yeah, sure. You want me to stay on and let everyone go?
Okay, just for like half a minute.
Yeah, sure. Fine. I don't care. That's fine. All right, folks. Thank you very much. Good night. I hope you enjoyed being online. It took a little arm twisting of the undergraduates, but I got it solved for us, which is good. And I'll tell you, given the weather today, this was God's affirmation that we're right to be online and not driving around in this mess. So, thank you.
Thank you.
Thank you, Professor. Good night.
Thanks, Professor. Have a good night.
You too.
Good night.